welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Marketfy. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have Scott Redler on the line. He's chief strategist at T3 Live and T3 Trading Group. Scott, how you doing today?
I'm doing great. Good to be on the show, starting a new week. We got Monday, got a lot going on, huh?
We do. And the first thing I want to talk to you about is that move on Friday. And we had a lot of consolidation in the market, tight ranges for a few days. And then early in the session, it kind of broke through that support that been, holding earlier in the week. And I think me and along with a few other people kind of said, okay, we're breaking down through the bottom of the range. But sure enough, you get a little Greek news and a little bit of a rally, and you bust out the new all-time highs. Just looking back on your trading from Friday, that move through the down, through the support, and back up. What did you use as a trigger that said, hey, that breakdown was a fake down, and we're going higher?
Well, this is, we've talked about the red dog reversal and different types of red dog reversal at key spots. The first one, obviously, back in, on March 2nd, when you look at the lower end of the range, when it broke below that, and, the market didn't know if we were going lower or if we were going to reverse back up. So up here, where we saw last Friday, it's similar. It's not as strong. It's a different type of thought process, but I was long also a lot going with the Friday, I think 5 or 6 positions. And in my head, I said the same thing. I'm like, can we hold above 2093, which was the prior peak back from, what was that, from 1229?
Uh-huh.
So once we broke below that, I did lighten up some of, I'm in the Russell, I was in the Spiders, and that was probably the first time I didn't add into that low end of the range. It was a lot easier to add. I was actually in Puerto Rico for the week, so I was actually putting buy orders in, and I was playing that range. And then Friday did feel a little bit different, but with the age of computers, I feel like they did that to get loose traders out of stocks. They came in, they broke it below, and then came back above, so stopped some uncommitted longs out, and then the market didn't look back. So for me, once we broke below that pivot and came back above it, intraday around 10 o'clock, you could then put some positions back on, or added back versus the lows, and then it became a clear trade. Or if you even waited, said, I'm going to see if we could take out, 2102 in the SPX, and use that as a trade for a squeeze above highs, and then all of a sudden you had a move that was strong to the close. So I think that the computers know where these stops are, and you just have to either give them a little bit more room with less size, or you have to be super quick where you get out, because who knows? The market could have failed that day. The 8-day might not have held, and, we came a long way from those lows. So, reducing risk is fine, but then once you get that new point of reference in the first 30 minutes, then you could trade versus that, because in the first 30 to 60 minutes, you don't know where that point of reference is. So you're better off reducing and letting the market tell you where that is.
And do we have a potential for a red dog reversal in the S&P futures today? I mean, we did break out to a new all-time high, major area of resistance. That was breached. Now, rallied a good, 9, 10 handles above it. Do we have a potential for a setup in the broad market today as far as a red dog reversal?
Not really, unless the market goes from red to green and goes positive, pushes above 2110, and then later in the day comes back below it. That would produce a red dog reversal. Today, all you have is futures down 4 or 5 handles. We were, well above the lows. So, we've seen this before. I think for the last week, the spiders have been down 40 cents, and then all of a sudden, at some point, they regroup, they go green, and they push, which is usually bullish action. Bullish action is you open weaker and you end stronger versus open stronger and ending weaker. So for today, I know for me, 2102 is support 1. So I would think if we could hold above 2102, which was that prior resistance on the flag, I think that would be very constructive and very bullish. If they want to push traders around like they did on Friday below that, the 2090, maybe they push a little bit below 2100. But I think ultimately on an intermediate basis, you really have to give it to the 8-day, because if you look at the 8-day, the market's been up above the 8-day ever since we reclaimed 2024, and that was back on March 3rd. So it depends on how tight you want to be. For me, I've been doing better with less shares, with a little bit more space than too many shares where I can't handle if they push the envelope a little bit.
No, that's a good way to approach things. One more macro thing, then we'll move on to some individual issues. Barron's was pointing out that in 2000, when the NDX hit 5,000, the index was trading 100 times earnings. Now we're back at that same level, and we're only trading at 21 times earnings. I mean, to me, that sounds like an extremely bullish scenario.
Sounds very bullish to me too, except if you're short and you're trying to look for storytelling on why it's not, to be honest.
Okay.
Um, it's a lot different environment. That also goes to prove, like, I like the fact that Barron's wrote a positive article because it seems sometimes they usually have a negative bias, and they sometimes scare the individual investor. But I think with the Nasdaq back approaching that 5,000, it'll give some people a wake up call if they're out of the market and say, you know what, I didn't approach the market right then. I got stopped out. I was on margin. I didn't stay the course. I didn't do monthly inflows. I didn't have a plan. So it always brings attention back. I do think, we're going to get up to the 5,000. We might kiss it and play with it a little bit and come back a little bit. And the Bears will talk about a double top, but then I do think with the storyline that Barron's wrote, I agree. The PE's 20. All these tech stocks that survive have viable businesses, and most of them do. They have cash on the balance sheets. They're doing buybacks. They're giving dividends. It's a lot healthier Nasdaq 5,000 than 15 years ago. So, with that being said, I still think that Nasdaq has helped give clues that it's there's an appetite for risk, and I think there's lots of opportunities there versus the bears just waiting to call a double top and say we're gonna crash 30 to 50% or something like that, where the market hasn't even been able to sustain a 10%
100%.
move lower for more than a few sessions.
All right, let's talk about some individual issues here. Apple, new all-time high on Friday, trading up in the pre-market. Once again, Barron's looking for, perhaps another 25% upside here. Have you been trading it, swing trading it here? Any kind of targets on the upside, or any areas on the downside where if it broke support, you might be a little bit concerned?
I'm a little flat-footed on Apple right now, just because I went away, and it was my major focus in February. In my 2015 thesis, I put a target on 130. Last year when it was at 77, when they announced their split, I said iPhone to head is a funny call. It's going to go 100 plus when everyone else was calling it Microsoft, and it did it. This year, I was like, I think it continues. I don't think we're going to have the same type of percentage move as we had last year. So I put a number figuring if we get above 119.75, the old highs, we should be able to get to 130, and that's where we are now. People approach it different ways. Some investors just sit in it, and that's fine. As a trader, it was very interesting after earnings. You look at that earnings gap, it never violated it the same way the past two quarters happened, where you had an earnings day and it digested. So I was recommending people buy versus the 115.31 low, which was the start of the gap from earnings. And then once we were looking at that 120.51, which was the prior high, that was a great momentum breakout trade. And then if you look at that 3-day quick move into 124.92, that's when I sold my swing long, because one of my rules is 3 strong days, I trim and trail, and I was leaving. I was like, you know what, I'll sell the Apple here. Hopefully I get another setup. I have a call spread on. Also, I bought the 120s when it was 118, and then on that third day, I turned it into a call spread, so 120, 125. So that's fulfilled its potential. So right now I'm flat for Apple, but you know what? I'm going to be patient here. Some people who sell too early, all they want to do is short it because they think it owes them because they sold too early, but it hasn't proven as a short. It's extended from the 8-day moving average right now. The 8-day is 126.62. Doesn't mean it has to go back to it, but I don't like to buy things gapping up after a big move extended from the 8-day. So I'm going to just kind of avoid it for a little bit and wait for another setup. The same thing happened to me in Apple. Really, last quarter too. Last quarter, had the gap up after earnings, gave you a consolidation and broke above that 109.50. I played it up to about 114, and then I missed the run from 114 to 119. But then, obviously you see how it took 3 months to reset up. I didn't chase it, and it's fine. So for investors or traders out there, if you're not in Apple right now, I would not be initiating a new position because Barron says it's going to wherever it said it's going to.
Yep.
But it doesn't mean it's a short either. We have to wait for a setup, and the best setup was right after earnings and when it broke above 120.51 and held it, and now it's trending. And as long as it stays above the 8-day in trends, I would stick with it if you happen to be in it. And if you're in it, you're better than I am right now because looking at it, and it's just it's not my setup right now, so I'm waiting.
We have Scott Redler on the line. He's chief strategist at T3 Live and T3 Trading Group, making a great point here. And I think maybe short-term, day traders or intermediate traders look for revenge trades, and that's a no-no in Scott's book. So that's a great note. What about the oil patch here? Crude after it's dipped down to 44 bucks, been trading north and south of 50, kind of a trading range. We did get down to the lower end of the trading range here in crude. What's your take on, perhaps the XLE, or is there any good setups in the oil patch?
I think you have to watch oil today. Every time oil, has gotten into the lower end of the range, it somewhat got saved and it's kept the range intact. Market's kind of comfortable now where we haven't heard new lows in oil for almost 2 months now or something like that. So right now, if you look at the USO is, it's a little bit below 18. I'm going to wait to see if it puts in like a 15, 30-minute low. I might try and buy the dip in oil this morning versus that low. But if we get a close below 18 in the USO, I think you're going to start hearing people saying that, oil has to test the lows, or, you're going to start hearing 30s and 20s again for oil, and that could raise some volatility in the overall market. So I think today, tomorrow is going to be pretty important as far as oil and psychology there. And as far as the XLEs, this has been a broken sector. It's giving you a nice trade off the lows. You could see a trend that's pretty much formed from the lows. If you look at it, actually, there was a nice red dog reversal, by the way, on January 14th. Just to give you another example of the strategy. It traded below 72.88, put that low in at 71.70, traded above it. That was your entry with a stop at the low of the day. And since it, it's rallied, up into the 82s. So I would say at this point, if you're trailing it and you're looking to see if there's still commitment off the lows here, I'd write down this like 78.50. If the XLE breaks 78.50 and the USO is closed below 18, some people might try and short the XLE, which I'm not probably going to do. But I would say if you've been trailing it long, that's probably a spot if you're active to get out of the way and figure out what's next.
Okay, another one of your favorites here, Facebook, and it seemed to take off last week when they came out with that huge valuation for Instagram. Had been really, this thing's been in a trading range here. I'm going back to November. Since November, you haven't traded much below 74, and really not much above 80. And you snuck above 80 on Friday. You're back up again today here. You're holding on, trying to hold on to a Facebook long here.
I am. I actually was watching it from vacation in Puerto Rico, which goes to show you that you don't have to always be in front of your computer screen. And I knew that 50-day and that trend line was around 77. So I re-entered Facebook last, I believe it was like Wednesday. Or was it? Yeah, I think it was Wednesday when it went above 77. That was your first real igniting move that we've seen in a while. So I'm hoping that it could rest a little bit up here, show upper commitment versus just being erratic, because for the last 7 months it's been pretty erratic and streaky and, just in that range. And that's what ranges are meant to do. They're meant to tire you out and not have people involved. So I am long Facebook. I'm going to put a stop in around 78.50. Okay, 78.50 was, the prior resistance that should turn into support. I'd love to see it hold, to be honest, above Friday's low. Would make it very easy, 79.20. And if it holds above 79.20, goes sideways, you could see a nice little bull flag form. And then, with a little bit of time, it takes out 80.34, which is Friday's high. And then, why wouldn't it go back and at least test that 82 area highs? A lot of people, Facebook had a huge move, and I was a huge bull on it back when it was 26, 27. I did a segment with Kramer on why it can go back to 44, whatever. But if you look at it, it's still a young company, and it still has only really since, where it opened as far as an IPO, what's it up since then? It's up, 200% or so from wherever that was, 44. Actually, it's only almost a double.
Yeah.
So
yep.
With the consolidation for 7 months after a double makes a little sense, and with time, perhaps it can go again. So at this point, I would be watching it this week. I think this week, there could be some action. And, again, holding 78.50 breeds some confidence for a move above Friday's high to get back to the 82 area.
Yeah, and a number like 82, I mean, you certainly have to respect nice round number like that. The longer it holds that, the more pressure it applies to the people that are shorted. Twitter pausing here after the run-up off earnings really doesn't showing any signs of going down here. What's your take on Twitter?
Twitter was my actually social media focus from the report. Got long the options prior to earnings because I don't take stock into earnings because you never know, and that was a good move. You had your earnings gap, put a low in at 45.80, and then it hovered for 3-4 days. I actually got along the stock versus that because you finally had a point of reference, which was 45.57, and I'm still in it above the 8 day. I think it's still going to have higher prices. It's a little wishy-washy. Trade's very thin and it's full of spurts. For me, I'm going to probably stay long, and if it were to get below, I would say 47.40, which is the 8 day, something that hasn't done since earnings, it would be frustrating. I'd love to see it do a little bit of work, kind of like Facebook above Friday's low, 48.65, and then the next major resistance comes in a little bit, north of 50, which is like 52, and then you have a bigger resistance a little bit closer to like 55. Actually, 56 was the peak from October 9th. So it's trading better. I think you could do it two ways. You could be long versus the earnings gap and just let it work itself out, or you could, actively use tiers with it. And if you're doing that, make sure that it holds the 8 day, and that's a little bit closer to 47.80.
Before I let you go, Scott, I got to ask you, why the 8 day? I mean, I've heard a 5 day, 10 day, 20 day, 50, 200. How'd you come up with the 8 day moving average?
I could tell you, but then I have to come after you and give
Yeah,
you
I knew you
do.
were gonna. Okay, all right, because it's not the 7 and it's not the 9, and it's like not 2 weeks of trade is 10. So that's good. You're protecting the secret sauce there. I definitely respect
It
that.
actually, it actually really isn't that much of a secret sauce. A lot of people use the 10, the 20, this and that. It's part of my process. I think I use the 9 and the 21. There's a fib sequence in there, but also just because, you know, any trend that works for you that you watch and follow,
There
and
you
you're
go.
comfortable with, that's what you should go with. For me, five day might be too close, and I might actively use it too broadly, or the 21 day might, be too loose, and I can't hold my risk. So for the 8 day, it's something that's been working for me, and I'm gonna stick with it. And again, because too many computers are programmed around the 10 and the and
Exactly.
the and the 20 and the 100, I like to use sometimes something a little offbeat.
No, that's a great point. Getting ahead, getting in ahead of the 10 days and the 5 day willy nillies. Maybe you got a little bit more staying power. Scott Redler, Chief Strategist at T3 Live and T3 Trading Group, joining us here on Benzinga's Pre Market Prep. Thanks a lot, Scott. Great information as always. Have a great trading day, and we'll talk to you again soon.
My pleasure. Thanks for having me.
All right, S&P's crawling back here a little bit, only down 2.25 here, 2104.75. Kind of a real slow, methodical sell-off here in the morning, but coming back mid-range on the day. We're going to take our final break of the day, and we're going to get some options instruction with Russell Rhodes. He's a senior instructor with the Options Institute at the SIBO. Be right back with Russell.